Hello world! Welcome to Farm the Market. What are options used for? In this video, I will review how traders and investors decide to use options as part of their strategies. Options are very versatile instruments and can be used for a multitude of purposes, but let's take a look at the basic principles behind what are options used for. If you are new to the subject, I recommend that you check out my Options Basics playlist in chronological order. As always, for all the examples, the figures are hypothetical, any commissions are ignored. Hedging. As we discussed in a previous video, fundamentally options exist to transfer risk, so it's logical that one of its main uses is as a hedge. Hedging means taking an offsetting position with the objective of reducing risk. This has nothing to do with hedge funds. I mean hedge in its simplest form, as insurance. Remember, risk can only be mitigated, but you cannot eliminate risk completely. Let's look at an example. We will compare the payoff profiles at expiration of an investment in SPY and two hedged variants using put options. We assume the investor has $42,900 available to start his portfolio. The underlying and options were bought at the same time and the period is 1 year. For the unhedged investment, the green line, the payoff is quite simple. There's a linear relationship between the performance of SPY and the profit and loss at expiration. If SPY goes up 15%, the return on the investment is 15%. With this individual position, we have all the upside potential as well as the downside risk. For the first hedged position, the red line, we add a long put option with an at-the-money strike. Since the strike is at the money, our hedge starts at the same price we bought SPY. Our worst case scenario is losing the premium at expiration if SPY has a negative or zero return. To break even, SPY should go up 10%. Past that point, we are in profit territory. In this case, we reduced the downside risk, but we need a considerable move up just to break even. In theory, hedging sounds great. Reduce risk and still have upside potential. But in practice, it's not that simple. Hedging is usually very expensive. Often, a simple at-the-money hedge will not be viable. Let's look at the second hedged position, the blue line. This time, we add a long put option with an out-of-the-money strike at 350, about 10% below the spot. This reduces the cost of the premium from $3,900 to $2,300. Effectively, we lower the break-even point, but in exchange, we take more risk compared to the previous hedged position. Using an out-the-money strike is only one example of how to reduce the premium cost. It is also important to consider that the capital required to open each position is different. We must add the premium cost to the investment. There is no single answer to what the best hedging strategy is. There are as many variants to a hedge as there are investors or traders. Each one must consider a multitude of variables such as risk tolerance, market expectation, correlations, and costs before implementing a hedge. The general idea is to look for balance when thinking about a hedge. Speculation. Now let's go to the other extreme of the spectrum. One could argue that everyone participating in the market is speculating to a certain degree. But for our purposes, we will think of speculation as a trade where there is a substantial risk of loss, but also a significant profit potential. One of the aspects that make options very appealing for speculation is the leverage they can provide. Typically, we might think of leverage as borrowing money to increment your exposure, and therefore enhance your potential profit or loss. However, options can provide leverage just given how they work. No need to borrow capital. When you buy an option, you only must pay the premium. That is the only capital you need to open a position. The actual premium depends on many factors such as volatility, moneyness, time to expiration. But in general, premiums of options relatively close to the spot represent just a fraction of the underlying price. Therefore, with a relatively small capital investment, you are exposed to a larger notional amount. As an example, let's say we have investor A, who has $39,000 available to start a portfolio. He did some research and expects good things for the US market during the next year. So he decides to buy 100 shares of SPY at $390. Investor A has a friend. Let's call him Investor B. Investor B hears about his friend's investment idea and decides there's no reason why he should not do the same. He hasn't saved as much as his friend. He only has $3,000 available to invest, but he does not want to hear a year from now how much money his friend made and how he missed out. After doing a few web searches, he stumbles upon options. He's in a rush. After all, his buddy will make the investment before the day is over. So, he makes some superficial research about options and finds out how easy he can leverage his position. For him, it is a no-brainer. Posts of people becoming millionaires by just buying options are everywhere he clicks. So, he decides to invest all his money and buys an at-the-money call. He feels great. 1 year from now, he will be able to show off to his friend. Let's look at the payoff profiles at expiration. For the investment on SPY, the green line, the payoff is quite simple. There's a linear relationship between the performance of SPY and the P&L at expiration. If SPY goes up 10%, the return on the investment is 10%. Nothing crazy. Investor A will have a return in line with the market. For Investor B, the red line, the capital requirement was just $3,000. He has exposure to 100 shares of SPY at a price of $390 for a fraction of the capital, 13 times less capital than his friend. That's where the leverage comes in. As you can see in the graph and table, the relationship between the two positions is not linear. The return on the call grows much faster in percentage terms than the return on SPY. Of course, the call is not just fun and games. There's only a positive return once the option is worth more than what Investor B paid for it. In this case, he needs SPY to go up more than 7.69% at expiration to reach the break-even point. And most importantly, we must consider the scenario where the underlying has no return or a negative return at expiration. In that case, Investor B would lose 100% of his investment, the whole $3,000, gone, just like that. You might say, okay, I get the theory, but come on. No one just leverages his whole portfolio buying individual options. That's crazy. Well, think again. Happens more often than you think. Leverage can be really tempting. And if you happen to ride a strong trend for a while, you might think you are the best trader ever and that options are just money printing machines. You can have 99 winning trades, but with no risk management, one single bad trade can wipe out everything. Things work until they don't. I'm not here to demonize leverage. As I said before, options are just tools. Depends how you use them. Also, in this example, we took a simple approach and just considered the scenarios at expiration. But in general, speculative positions are short-term and closed before expiration. Along with price changes, factors like time decay and volatility changes play a huge role on open positions. When speculating with long options, you not only have to be right about your market assumption, whether that's linked to the price or volatility, but you also have the clock ticking against you. We will look at those factors in more detail in future videos. Investing. Last but not least, options are also a viable instrument for investing purposes. Given the characteristics of options, they can be used as a complement or replacement of traditional positions to maximize returns and reduce risks in a portfolio. Cost efficiency. Let's go back to the hedge example. You might have noticed that the payoff profile at expiration of the hedge positions, long SPY plus long a put, looks familiar. Take a moment to think about it. Okay, that's right, they look like long calls. So, what would happen if an investor looking for exposure to SPY but with reduced risk looked into buying just a call instead of buying the underlying plus a put? Let's compare the payoff profiles at maturity of the long at the money call versus long SPY plus long and at the money put. As you can see, the P&L potential is practically identical. The biggest difference is the capital requirement. For just a fraction of the capital, we have basically the same open position. This is leverage used with prudence and moderation. This frees up capital in your portfolio, which could be allocated, for example, in a low-risk fixed income asset that helps you boost a little the return in your portfolio. Nowadays, short-term rates are negligible, but I think you get the idea. As a side note, if you have ever heard the term capital protected structured product, this is the principle behind those type of instruments. You might have noticed in the example, the call is cheaper than the put. But wait a minute, both have the same strike, underlying, and expiration date. Why the difference? Am I just trying to make the call look better arbitrarily? Although the prices in the examples are always hypothetical, the relationship between the call and the put price used here is relevant. In general, for an equity underlying, puts are more expensive than calls. You can thank the volatility skew for that. In future videos, we will cover this topic in more detail. I like this example because it combines the benefits of a hedged position and the use of leverage to make the strategy more cost efficient without taking disproportionate risk. This is just one of the ways options can be used to maximize the potential of a portfolio. As you might imagine, there are many strategies based on options that can replace or complement many positions in a portfolio. In future videos, we will review more examples of these strategies. I hope you found this information useful and interesting. Remember that everything presented here is for educational purposes only. If you liked the content, please don't forget to like this video. If you haven't already, I invite you to subscribe to the channel and turn on notifications so you don't miss future videos. Thanks for your time.